The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome, everybody. Thanks for being with us. We've got another episode of Something More with Chris Boyd. Thanks for being with us. I'm joined again by Jeff Perry and Brian Regan, both of Asset Management Resources, as am I. And today we're going to be talking with Brian a little bit more about some economic topics and in particular, what's going on with fixed income. Treasury bonds have caught his eye as to what's happening there. And the idea of housing, we're going to talk a little bit about housing along with a variety of other topics. So Brian, let's jump right in. What's going on with treasuries that you wanted to bring to our audience's attention here?
Well, if you look at long-term treasuries, I'm finding this particularly interesting. The TLT, which is the 20-year treasury ETF, I recently saw a chart, is on pace for the third consecutive negative year, which
has that happened before?
My understanding is that has never happened before. So we're in unique territory when it comes to long-term bonds. And I think this is particularly interesting because I don't know if you guys remember this, but not too long ago, I heard a refrain that, everybody knows that yields are going down. Not too long ago, I remember specifically I was in a conversation with somebody about whether they should get a fixed or floating rate mortgage. And I always advocate for a fixed rate mortgage, just FYI, always, because I don't pretend to know where interest rates are going at any given time. But
if yields were going down for our audience, that would mean that prices would be likely to be going up, and therefore you'd expect to be making money in bonds.
Right. So yields have continued to go up on longer term treasury bonds, which has been negative. Despite this, you got to feel better about the future of treasury bonds conversely, right? Because the yields are higher. So the buffer that you have on returns going forward is better because the payments from the interest payments and coupon payments are going to offset any additional, uptick in rates. So, this is definitely challenging, especially going into the third year of a negative total return on longer term bonds. I think it's a good thing. Quite frankly, we're not positioned where the 20-year part of the curve.
So it's not a worry for our clientele or anything like that.
Yeah, in fact, we've been positive on our fixed income year to date, but that's mostly because we've been targeting very, very short part of the curve. I'd say we'll call it cash plus for lack of a better term. Yeah. And that's because we, continue to advocate targeting the part of the yield curve where you're going to get the most incremental return for the least amount of risk. I call this the fat part of the curve. It's usually the part of the curve that's humped. And when we have an inverted yield curve like this, it's rather unique where we can actually get more return and take a less interest rate risk, which is a nice trade-off, and that's what we've been doing. But this does
come back to imply what we talked about in a prior discussion was this question of does this imply concerns about a recession from bonds? The idea that future interest rates would be lower than current interest rates typically implies worries about future economic outlook.
Well, I think it comes back, right? In 2022, we saw rapidly rising wages, and that, to me, that's not a recipe for a recession. And now we're almost seeing the exact opposite, right? We're seeing wages slow or moderate, which is good because it brings down inflation. But we're also continuing to see rates rise. So the prices that you pay for a loan, for the cost of money, is higher, but the disposable income that you have is lower. That doesn't mean that we're going to have a recession necessarily, but it does mean that we're going to, in my opinion, see a slowing economy over time, a slowing economy, albeit from a very high level. Right now, we're likely going to post something close to 5%, which is, remarkable. So there's room to come down, which is why I think people are feeling very confident right now that there's not going to be a recession. But I would just, caution people that you should always be cautious to some degree.
Jeff, do you have anything you wanted to chime in on that?
More of a question for Brian. So if you have someone who's a fixed income investor and they would prefer to be long, meaning locking in some rates, what's that person to do now? They can go short and then get the nice 5%, short-term rate, but a lot of people want to invest for longer term and kind of secure their income, if you will. Is it time to start picking away at that longer term, or should those investors be waiting a little bit longer in case those rates do happen to go up?
Well, the rates might go up more, they might not. I will say that the real rate right now, the rate that you're getting above inflation seems to be very attractive based on historic norms, because the expected GDP in the market is higher, right? So if you believe that the economy is going to slow down and real rates will likely come in, it could be a good time. I'm not saying that it's not. I mean, we do allocate some out to the latter part of the curve, just because of what you're saying. There's could be some advantages to that when spreads are this wide above inflation. But I would caution it, right? If you wanted to buy the actual bond and not a fund, you should know that's gonna change in price too. Yes, you will get the yield promised to you every year, especially on a Treasury bond. But you're going to see unrealized gain loss. When you look at your statement, it's going to be reflecting that unrealized gain loss, just like a bond fund would. So, you could lock in your quote unquote income. And as long as you're comfortable with, getting 4% when rates could go higher, you're going to have an opportunity cost there. And that's going to be reflected in your unrealized gain loss. So I don't think it's necessarily a bad thing. If you know that you spend 4%, for example, and you can lock in 5%, that math might work out for you. But your spending's probably going to go up over time, which is something to consider. So I wouldn't put your entire allocation into, a 10-year bond, for example, where you could lose money and you might have to sell it to make ends meet.
Raises an interesting point, though, Jeff kind of brought up. We tend to think about when it comes to stocks that we want to buy them cheaply when they're a little bit out of favor. Do you not think of bonds the same way?
Is that me personally?
Yeah, Jeff. Yeah, Brian. That's what I had in mind.
I do want to buy bonds as cheap as possible. But where am I getting the cheaper bonds? I'm getting the cheaper bonds on the short end of the curve right now, right? They're more expensive on the longer end because the yields are higher on the shorter end. And mathematically, the way you're supposed to think about the yield curve is it doesn't matter where you buy at any given point on the yield curve.
Right.
The end result should be the same, yield to maturity. And the idea is if you were to buy a 3-month bond and reinvest that over 10 years, your return would be the same if you just bought a 10-year bond. And the reason for that is because that 10-year bond is supposed to reflect all the expectations of the
market's supposed to figure this out for us. But
right. So we all know that's not perfect, right? So to me, that rates change over time. So to me, take what the market's giving you. If the market's giving you more return for less incremental risk, and you don't know for sure what's going to happen in the longer term, and mathematically it should be the same. Well, you're going to be better off taking less risk and getting more return and buying the cheaper bond. So that's where I'd rather be rather than gamble, I guess you would say. It might work out for you, it might not.
Yeah, I guess that's to your question, Chris. That's the question, right? Because if you do that, if you go too short and you miss the declines in the longer term rates, you miss that opportunity. But as you say, Brian, it is a gamble because we've been, some people, not you, but some people have been saying this for a year or two, right? And they would have been wrong.
Yeah, I mean, being humble is an important part of investing, right? And I always err on the side of take what the market's giving you, right? If the market is going to give you if the stock market's going to give you a good company at 10 times earnings, that's probably a good deal, right? If the bond market's going to give you no interest rate risk and a lot of income, that's probably a good deal too. Sometimes you don't have to overthink it. That sometimes there is an opportunity in the longer part of the curve, but I don't think it's so glaring right now that you should do that. I mean, it might become more obvious when and if there is a liquidity premium, which there should be, right? You should get paid a little bit more by taking more interest rate risk or taking a liquidity premium. The fact that you might have to sell the bond into the market if you need the cash, that would be a liquidity premium. That's normally in the market, right? There's two reasons why we have an upward sloping yield curve. One is that you should be able to compound the interest over time. So, the 3-month compounded into the future should be, worth more if you just buy a longer term bond. The second and bigger reason is a liquidity premium. And there's no liquidity premium in the market. In fact, there's a negative liquidity premium. So,
right.
Where are you getting the advantage? You could argue that there's an advantage in real rates. We had zero real return for a decade. So, good luck with trying to figure out if there's a yield advantage in real rates. That's not, an economist would tell you that the real rate should reflect the long-term expectations of GDP. That certainly wasn't the case between 2010 and 2020. So, that is a whole decade. If you go on a 50-year period, maybe that's true, but you're taking an awful lot of risk if you do something like that. So again, I'll take what the market's giving me, which is less risk and more return right now.
Let's just before we move on to other topics, naturally one of the things that people also invest in the bond space is credit risk. We talked about that in the height of the bank issues, when there were failed banks, and the idea of maybe moving away from credit risk at that time made sense. What's your take on, is there sufficient spread and incentive for investors to be including or adding in more credit risk at this time?
I think this is a very dangerous time to be a high yield investor. I'll say that, and here's why. Right? What does the typical person with their 401k do when they're selecting a fund? They go down the list and they say the 1, 3, 5 year
more yield. Yeah.
What's done the best, right? And
okay.
there's no doubt that high yield's done great on all those metrics, right? So, but at the same time, spreads are fairly tight right now. I think we're looking at 3% on high yield, 1.5% on investment grade. It's not abnormal for those spreads to go to 7, 11%. And if you have a 5-year bond and you see your spreads blow out by, 4%, that's you're losing 20%, right? Plus your coupon, of course, so let's call it 13%. But that's not attractive. Nobody wants that. This is a scenario that could very well happen. The time that I like to buy high yield is when I'm getting pushback from everybody else at AMR, right?
Right.
When you guys are saying, "Are you sure we want to do this? This seems a little crazy." So spreads are usually at 11, 12% at that time, and there's more downside opportunity in yields, and that's attractive. Now, high yield's done very well because inflation's been high. So what's been going on is companies have been able to increase price. They've been able to generate cash flow. They've been able to refinance debt, or they've been able to term out their debt when yields were really low. So it hasn't been an issue. But what are we seeing now? Inflation's coming down. That could mean that margins get pressured as wages catch up to the previous inflation. That the stock market is lower than it was a few years ago, 2 years ago. So you can't issue more debt more easily. The small cap space is definitely much lower than it was a few years ago. So, they're primarily the high yield borrowers. So they can't issue shares into the secondary market to pay down high yield debt. If they do refinance that debt, it's going to be at much higher rates. So it's an interesting dynamic. They termed it out for, let's call it 5 to 7 years, 4 years ago. That waterfall is going to be coming at some point. So I'd just be careful, I guess is a long way of saying this. I personally love the high yield space because it gives us an opportunity at times to add a lot of incremental value to people's portfolios.
Yeah.
But I don't want to do it.
Now's not that time.
I don't want to do it, at the sake of adding more risk when it's not warranted.
All right, we'll quote Dana Carvey doing President Bush. Wouldn't be prudent, not at this juncture, right? Right,
it could continue to do well too. I mean, that's if we are in the next cycle of a bull market, that 3% spread is going to go to 2%, and the Treasury yield is going to go from 4 to 5. You're going to be continuing to clip a nice coupon, and it's very possible, a year from now, you can just say that Brian Regan guy didn't know what he was talking about, and that I acknowledge that that's a possibility. There's two sides of every coin, right? There's the opportunity and there's the risk.
Right.
And when the risk is greater than the opportunity.
Yeah, you just want to try to stack the deck in your favor, and
right. Exactly.
Yeah. All right. So let's take a quick time out here to mention that we have an upcoming seminar. Just want to remind you all that the Retirement Red Zone Financial Planning webinar is coming up on September 20th at 10 a.m. So if you'd like to participate in that, this is really geared toward people who are near retirement, or as Jeff, you've pointed out, it's probably pretty appealing for people who are in retirement to
absolutely
check up on, are they on track with everything they might want to be thinking about. In any case, if you'd like to register for that, you can go to our website, amrfinancial.com. We're going to have a lot to talk about. And it could be really helpful. We do these webinars twice each quarter, and Brian will be doing another one of these about 6 weeks down the road, pointing out sort of what's our take on what's happening in the economy and how that's likely to affect markets and how that implies portfolio positioning might be wise to do, as we do each week on our podcast here. Something More with Chris Boyd. So thanks for listening. Let's keep talking about some other things. Brian, you had wanted to talk about housing. I'd heard something on Bloomberg, I think it was this morning, where they were talking about housing in the UK and how that's different from the US. You had mentioned something in our show prep about Canada. Maybe you can jump off and tell us a little bit more about what you had in mind here.
Yeah, so we're blessed in the United States to have fixed rate mortgages. And I think we all think about the housing market in a possible crisis because the scars are still, they're still there from
deep wounds, right? Yeah.
But the reality is the vast majority of this country now has, I believe it's over 90%, or at least in the high 80s, has a 30-year fixed rate mortgage that's between 3 and 5%. So they're paying a very affordable mortgage, and that's part of the reason why you're seeing low supply in houses, because people aren't going to give up those mortgages, et cetera, et cetera, et cetera. But the more important thing is it seems to be that we're going to have stability in at least the residential mortgage sector. I think the commercial real estate sector might be a completely different story. Now, we're very U.S.-centric focused as Americans, and I think sometimes it's good to look elsewhere. And if you just look at Canada, where the housing prices make the U.S. prices look, infantile, they have a much different situation. So most of their loans are actually floating rate, but that on the face of it can seem kind of scary, right? They're going to have resets that go from very low rates, 0 to 2% to 5-6% easily, right? Maybe 7%, as we're saying here in the United States. That's going to be a dramatic difference for the borrower in Canada. Now, there's a silver lining to that, right? It's not as scary as it sounds. It's not good, but it's not as scary as it sounds for this reason. They don't do variable rate mortgages like we do here in the United States. In the United States, when the interest rate resets, the interest on your loan just gets added to the payment, and you pay a higher payment, and it hits your pocketbook very seriously, right? So if you were going to go from a 3% mortgage to a 7% mortgage, it might come close to doubling your mortgage payment.
Right.
In Canada, you have a fixed payment, but the amortization schedule changes.
The term of the loan can change then.
Right. So the interest you pay in your fixed rate is higher, and the principal gets lower.
So instead of a 30-year fixed rate, it might turn into a 35-year or a 40-year or whatever it might be.
Right, exactly, but with higher interest, right? So the good news is the payment likely won't change, which hopefully will say it's almost like an automatic restructuring of the loan, which is good for banks, but it's bad for the value of the loan. So I just think it's an interesting tidbit and something to keep an eye on how these things play out in other countries and how it affects the banking structure. In the United States, I think we have more commercial loans to be concerned about. But I think this is, especially if the amortization payment goes negative, because then you will have an increase in your payment. But I think all these things are things that I'm trying to actively look at and think about as they might affect, the global economy.
And obviously how that works into people's portfolio designs. Good opportunity to remind everyone, if you have a need for any help with your portfolio or financial planning, don't hesitate to reach out to us here at Asset Management Resources. Our phone number is available to you at 866-771-8901. Thanks for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources LLC and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.